Welcome to Thursdays for Future, Thursdays for Monetary Future. I don't know if you're familiar with our work, but nowadays everybody seems to be talking about environmentalism and sustainability, and often it's a bit, I would say, mostly virtue signaling. So I try to make a difference with our studies, with our research, with our books, by educating people about monetary environmentalism, about the sustainability of our monetary system, and why actually the inflationism that we're all part of at the moment will probably have pretty dire consequences for our capital structure and for our savings. So I don't know if you have come across this report. I'm writing it every year for 13 years now. It is a very broad analysis of gold, but also of financial markets from an Austrian point of view. And we published this report in German, in English, and now also in Mandarin. And the last report was downloaded more than 1.8 million times. So it's really well known all over the world. And this is our way to explain the world actually what sound money is and how to hedge and insure yourself from the monetary insanity that we are all in at the moment. I have to warn you, this will rather be the practitioner's view today. So I'm not an academic, I'm working in financial markets. I used to work in a bank, but then discovered gold and discovered the Austrian School of Economics. And after a couple of years, I felt like the vegetarian in the big butchery and had to quit my job in the bank. And therefore for me it's I'm very excited to be speaking here in Vienna, in my hometown, about the Austrian School of Economics, and especially here at the Austrian Central Bank. So, ladies and gentlemen, I will mostly talk about the interplay between inflation and deflation today. And as you know, financial markets have become extremely dependent on central bank policies. So grasping the consequences of the interplay between monetary inflation and deflation is crucial for prudent investors. Just a few things about our company. We're based in Liechtenstein. That's no coincidence. From our point of view, Liechtenstein is one of the best jurisdictions within Europe. It's 1 out of 5 countries without any government debt. If you read the papers by the Liechtenstein family, they call their citizens actually customers, so they treat them very well. So for us, it has been natural to move to Liechtenstein with our company. And what we try to do is use the Austrian thoughts in our asset management process. Now, I have to warn you and I have to disappoint you, ladies and gentlemen. Knowing the Austrian School of Economics necessarily doesn't make you a better investor. It will make you probably a better human being, a better entrepreneur, a more interesting man that questions probably everything, but it will not necessarily make you a better investor. And from my point of view, there are many opportunities, but also many risks when it comes to investing as an Austrian. First of all, the biggest opportunity and the biggest advantage obviously is the knowledge about the monetary system, the interplay between inflation and deflation. The beauty of those conferences is that you meet people that know about history, that are pretty interested in history, in our monetary history, and that know how inflation works and what hyperinflation does to our society and to our capital structure. So this is a big advantage compared to the mainstream investor. Austrian investing is not really a big thing. It's not very widespread among investors. So you've got some sort of a contrarian edge. You're able to understand alternative currencies. I would like to say that most of the people that understand Bitcoin Also, those that are coming from, I would say, rather from the technical side, have got a good understanding of our monetary system. And I actually love the fact that through Bitcoin, many young people find out about the Austrian School of Economics. And therefore, I love the currency competition that is currently going on. And I think this is a really big edge that you have as an investor. And of course, Austrian investors tend to have knowledge about the Austrian business cycle theory. But there are also risks. First of all, Austrian investors are very sensitive to flaws in a capital structure. Sometimes I see that there's some sort of quite a pessimistic view on capital markets. Some would call it doom porn. So if you attend conferences, sometimes you just want to shoot yourself because the scenarios that are described are pretty dire. We should not forget, as good Austrians, that there's actually quite a lot of positive things going on. And despite all the regulatory framework, politics and so on, actually there's quite a lot of entrepreneurial spirit that works against this regulation. Then, Austrian investors often have very extreme portfolios. Most people think that as an Austrian you have to have 80% silver and 20% gold in your portfolio. That's not really accurate from my point of view. Austrians tend to be very convinced, they're extremely dogmatic. And lastly, the Austrian school doesn't make any timing calls. So if you're bearish the market and if you're short the market already in 2015, well, you'll probably be out of business. So actually the timing is something that we are very careful about and that makes this Austrian view, when you're actually a practitioner in financial markets, quite difficult. Now, the big dilemma for investors at the moment is that investors are pushed into risk. We often see that banks say, equities are the new savings account. Well, on the long term, it's probably right to have more equity exposure, but I think those people don't really understand the volatility of equities. So negative real interest rates induce excessive risk-taking. We can see that in the real estate market, we are seeing it in private equity and so on. Retention is punished as long as asset price inflation goes on. I know many fantastic investors that, because of their asset allocation committees, basically have a very hard time to be out of the market. There is career risk going on in big banks and at big asset managers. So actually not be dancing on the party is a big risk for most investors. And there's a systemic misdiagnosis. So risk is underestimated until it is striking. I've attended a conference a couple of weeks ago in Switzerland, mostly institutional players, and they all said, we know that the markets are extremely expensive. We know that the market is addicted to central bank action, but we will get out of the market before it crashes. Now, in theory, that sounds pretty smart. In practice, I'm not sure if that's going to work out that way. But before we talk about inflation, we have to define inflation. And Mises said the most important thing to remember is that inflation is not an act of God, that inflation is not a catastrophe of the elements or a disease that comes like the plague. Inflation is a policy. And Fekete, that I really enjoy studying, said hyperinflation, hyperdeflation are just two different forms of the same phenomenon, credit collapse. Of course, there's also an alternative definition of inflation, which is inflation is when you pay $15 for the $10 haircut you used to get for $5 when you had hair. So, But nowadays, inflation for investors is something really crucial, and we should not forget that there are massive deflationary forces at the moment, and most people that had a look at balance sheet expansion in 2009 and later on, they were screaming hyperinflation, and those people tend to forget that there's enormous deflationary forces at work, like the balance sheet deleveraging that should be happening. We're seeing sluggish credit growth. We're seeing regulation. So for us, example, it is impossible in most of our funds to actually buy physical gold because based on the regulators, it is too risky. But we are, of course, able to buy government bonds and even 50-year government bonds without any yield. So we should not forget that regulation is very, very important when it comes to this tug of war. And there's the so-called high demand to cold money. Many people would say very slow velocity of money. But the inflationary forces, that's basically what central bankers and politicians are responsible for. So that's zero negative interest rate policy, communications policy. So nowadays, I think the markets are only eager to anticipate what central bankers will say next. When you talk to people that were in the markets 30 years ago, actually they didn't care about central bank policy because it was not that important back then. Quantitative easing, of course, is a measure that is taken and that will be taken again, although there is massive declining marginal utility. We're seeing currency wars and then, of course, MMT, QE for the people and helicopter money. That's actually what's going to happen in the next couple of years, obviously. Now, what is the Fed already suggesting? They're already talking about a return to zero rates. Janet Yellen, who looks like the grandmother of Harry Potter, says the Fed might turn to QE in another downturn. The Wall Street Journal quotes a paper by the San Francisco Fed. San Francisco paper says a benchmark rate of negative 0.25 may have been the optimal setting. So they are preparing the markets already for negative rate. And Jay Powell says we have to introduce some make-up inflation, as they call it. So they didn't reach their inflation targets, so probably they have to come up with a new, I would say, higher inflation target. And the bulls, they got hungry. So they expect 2 rate cuts at least in the United States. From my point of view, there will be 3 to 4 at the minimum next year. What's going on in the Eurozone? Well, this was not on Zero Hedge, it was actually in the Financial Times, and it is based on the last ECB meeting. So Christine Lagarde, she will oversee a strategic review. If you ever worked in a big company, well, if your boss tells you there's going to be a strategic review, it's not going to be a good thing. She is open to even more radical ideas, like changing the inflation target or paying money directly into individuals' bank accounts. So here we go. Just have a look at the testimony of Christine Lagarde at the European Parliament. She's very open talking about Eurobonds, fiscal stimulus, about helicopter money, you name it. Yeah, so it is a very political decision, of course, and we should not forget that she was the boss of the IMF. So basically, yeah, she was bailing out Banana Republic. So we will see. You can see on this chart that this exponential growth that we need in the monetary system, we're a bit behind. So actually, we have to stimulate consumption. The problem is that we're seeing some saturation when it comes to consumption, and that is actually what the Federal Reserve is very, very concerned about at the moment, and this is the reason why they are so eager to keep the stock markets up, because of this so-called wealth effect. Now, why is inflation important for investors? Because falling inflation is paradise for bonds, but also for the equity markets, while rising inflation is of course negative for bonds, but it's also a hostile environment for the stock market. So you have to be very careful with picking your stocks in an inflationary environment. Not every company has got pricing power in an inflationary environment. Inflation-sensitive assets have to be timed. So we have created our inflation signal that is basically showing us what are markets telling us. Do markets see higher inflation or rather lower inflation in the future? And actually, it's pretty interesting. Inflation, so rising inflation, seems to be a very, very contrarian topic nowadays. There was Bloomberg Business Week saying, is inflation dead? And then The Economist came out with the end of inflation. So it seems that nobody is really concerned about rising price inflation. Our signal that tells us the positioning in our funds, actually it switched to 100% inflation signal. So we are playing offense now. We're investing in mining equities, in commodities, in commodity currencies. We'll see who's right, but the market is telling us that actually inflation might be on the horizon. And I'm not talking about extremely high numbers, but at least a move in inflation numbers. Now, the conclusion, we wrote this book, Austrian School for Investors, together with my dear colleagues Rahim Tagitzadegan and Mark Walek. Good investors differentiate themselves from bad ones in times of crisis. I always make the comparison with skiing. When the weather is fine, when the snow is fine, everybody is a good skier, even the Dutch. And I hope there's not too many Dutch in here. But when it's really, I'm sorry about that. But when it's really icy and foggy, then you can differentiate if you're a good skier or not. And it's very same in financial markets. Followers of the Austrian school have been extremely successful in anticipating major economic events. So this is definitely something that gives you an edge as an investor. Grasping the consequences of the interplay between inflation and deflation will be crucial for investors going forward. I think this is one of the most important numbers and one of the most important drivers for financial markets going forward. We all know that there's 13 trillion of bonds yielding in negative territory. Now, what is the biggest pain trade for those bonds? It is rising inflation, of course. It would have an enormous consequence for markets. And radical monetary interventions will not lead to a self-sustained recovery, but to further turmoil in financial markets. We see that market participants got really addicted to the safety net that the Federal Reserve and central banks have created. And as soon as the punch ball is taken away, like we've seen in Q4 2018, it will lead to turbulence. So, ladies and gentlemen, let me thank you for your interest and finish this session with a quote by a very renowned economist saying, "There were ample warnings, there were always subtle signs, and you could have seen it coming, but we gave you too much time." Who said that? Guns N' Roses. So, thank you very much, ladies and gentlemen. Is there some time for questions?
Thank you very much. We have time for one very quick question and answer. So I see one hand back there, please.
So, as an Austrian investor, what's your position on Mark Spitznagel's strategy of high ROIC companies and the out of money puts in case of a crash?
You mean Spitznagel? What?
Mark Spitznagel book,
Mark
The Dow of Capital.
Yeah. I think it's a fantastic book on Austrian investing. Actually, he published it a bit prior to our book. And there is no Austrian investing, actually. Yeah, we named a couple of strategies, like the permanent portfolio, for example, but also strategies like Mark Spitznagel. We're also writing about value investing, which has, from my point of view, a very Austrian functions at some times. But if you want to learn more about Austrian investing, there's fantastic writers like Kevin Duffy, for example. There's Mark Spitznagel, but there's also, of course, people like Nassim Taleb, who has got a very similar strategy like Spitznagel. I think they work together. But what I want to say is there is no Austrian investing. I think everybody for himself has to define what's my investment strategy. We wrote in the book that actually an investment in your education and your knowledge is probably one of the best investments, and therefore I think attending such a conference is also a great investment. Thank you very much.
A round of applause, please. All right, ladies.